Yes, well, it's a common theme, this higher for longer. The reality is there's quite a bit of confirmation bias going on here as well. For many people in the industry, they've never seen a higher interest rate environment. They've just seen interest rates go in one direction, that's lower. Now, the upside of all this is that we've just come off of one of the strongest quarters we've seen in the last 2 years. Over 82 billion euros went into fixed income in the first quarter of this year. It's also significantly higher than what we've seen even just a couple of years ago. So fixed income, in a way, used to be a term we stopped even using. We used to say there was no income in fixed income. Now we see fixed income coming back and many more opportunities than we have had in the last couple of years. Well, if you look at on the surface, they do look like they're fairly well correlated. However, these are very deep and much more complex markets. And we think, given the backup in interest rates, present far more opportunities than we've had in past years. So if I look at public markets first, I think on the unconstrained side, hedge funds specifically are a great opportunity. We've seen significant growth in 5 of the 8 strategies we've got that are running long short in the credit space. On the private side of things, I think there's also many opportunities, especially in the areas of special situations. Well, for our industry, there's probably 2 things to discuss. One would be on the investment side, the other would be the business itself. So when it comes to investment thesis, we believe sustainability versus ESG is a real opportunity. The issue we face industry-wide still is a lack of clarity as to what is ESG versus sustainability. And I think if we look at one of the consultants reported in 2027, we'll spend over $7 billion on ESG-related costs as an industry. Now, that's because there's no one single definition of what ESG looks like. On the other side, I believe that people are coming together around sustainability and engagement. How do we move to a new environment? And I think there'll be incredible opportunities to help fund what will go well beyond our industry as far as benefiting society. The second piece is around business. And I think there are really 2 things that are taking place. The first, the requirement for scale.
What?
Firms that were small and mid-sized will not be able to deal with some of the headwinds we face in the industry. Those headwinds include 3 different things. The first one being regulation, both post-Brexit, as well as regulation taking place inter-country, which is affecting some of the innovation that we see, especially in private markets. The second area is the area around ESG. As I just mentioned, the costs around and associated with ESG are significant. And then finally, I look at technology and the impact of technology around AI. I hear all the time that AI will end up saving us money, but there'll be quite a bit of investment that goes on beforehand. I use our parent company, RBC. They spend over $4 billion a year on technology alone. For small to mid-sized firms, they will have a very difficult time being able to fund the transition that'll have to take place. So scale will be required. The second piece, and you see it here at the conference, is the convergence between alternative and traditional asset management. As alternative shops move into more traditional asset classes, as well as into traditional channels, as far as sales channels, they're going to find that they're going to have to rework their own businesses. Similarly, traditional asset managers are going to have to rethink how they organize their investment thesis and their investment platform to get the full leverage out of their firm to deliver alternative capabilities. We believe firms that can navigate between those 2 areas will succeed. And that, for us at RBC BlueBay, that's exactly where we sit, which is at the convergence point between alternative and traditional asset managers.